Hi there, welcome to Kneppy Invest. Time for another portfolio and technical update video. I tend to release these videos every single Sunday. Can't remember the last time I didn't release this portfolio and technical update video on a Sunday. And in each of these videos, I go through the performance of my portfolios. Currently I have three using different strategies. One strategy or one portfolio is performing better than the other two. So possibly moving forward, that's a strategy I should employ on a full-time basis. And when I say full-time basis, I'm talking about that's possibly the only strategy I should be using. Not only is it performing really well, also enjoy using that strategy. And that is the technical or trading strategy, or using the technical trading strategy, using charts, that sort of thing, doing really well. And I thought in today's video, I'll go through all the companies that are currently owned in my trading or technical portfolio and just talk about what I'm thinking right now, currently on January the 28th, about those particular trades, whether I'm thinking I might sell in the next few days or whether I'm bullish, bearish, or even my conviction on those trades. Also go through commodities, indexes, looking interesting as well, and that sort of thing. And also might bring you a few other companies' charts that are looking interesting right now. But first thing I want to do is go through the performance of my three portfolios and also at the performance of three benchmarks I do use, which is the NDQ, which is an ETF that follows the NASDAQ 100, XSO, which is the Australian Small Ordinaries Index, and also the STW, which is the ASX 200 ETF. And we're also looking at different time periods here. So since the start of the financial year, the last 3 months, last month, and also week. In the next few months, also look at the last 6 months, because now we're 6 months past the start of the financial year. I've also color-coded this and also sort of highlighted, color-coded the best performing out of these three portfolios and three benchmarks out of these 3 or 4 time periods, and also the worst performing out of these 6. So I've decreased the font size and colored or highlighted in red those who that index, or not index, that portfolio or benchmark that has performed the worst. And I've increased the font size and highlighted that has performed the best over that time period in black. So if we look at since the start of the financial year, the best performing out of these 6 is a technical portfolio, up almost 30%. Can't believe it didn't quite get to 30%. So performing really well right now, even though I am trading Dominos Pizza. I actually have added to that position, but my conviction on Dominos Pizza trade was really low. So that was a really small sized holding. So it didn't really affect the portfolio or this portfolio's performance. Second best out of these 6 is the NDQ. NASDAQ has been on a tear, up 17.4% since the start of financial year. Then we have my small cap portfolio, up 16%. Then we have my quality portfolio, up 10.4%. That particular portfolio was significantly affected by Nanosonics and Domino's Pizza, and that's why that particular portfolio was down for the week, but only down 0.2%. And then we have the STW 7.8, and the Small Ordinaries Index is only up 3.8% since the start of financial year. So a significant difference between technical performance and the Small Ordinaries, even though I do like the Small Ordinaries or the small cap space. We look at the last 3 months, still technical portfolio outperforming the rest, but the NASDAQ or the NDQ is not that far behind at 17.5%. In fact, the last 3 months have been really good for the portfolios and also for the benchmarks, with the worst performing out of these 6 being the STW, which is still up 11.8% over the last 3 months. You can just see what has happened on international equity markets over the last 3 months. It has been a good 3-month period. The last 1 month has been really good for the NASDAQ, the NDQ up 7.9%, even though the technical portfolio is lagging a little bit behind, still up 4.2%. And the worst performing out of these 6 is a small cap portfolio, up only 0.1%. I'm not sure what's happening with my small caps in my portfolio because it's now lagging behind the Small Ordinaries. So something is happening there. I should have a closer look. And in the past week, worst performing is a quality portfolio, and that's because it was hit hard by Nanosonics and Domino's Pizza. But you can see, even though these two companies performed really badly, are down 30% in one day, it hasn't had a significant negative effect on the quality portfolio. And the best performing is the NDQ, up 2.7%. And just behind that is a technical, up 2.4%. So still, the technical portfolio is still performing really well. It is working. The rules I've set in place mean this particular portfolio works really well. The other ones, XSO up 1.3%, STW 1.8%, small caps only up 0.2%. So I'm not sure what's happening there. Now, I did get a question in my previous video in terms of my checklist. So I am developing checklists for my 3 portfolios and the strategies. I won't show you the checklist for the quality and small caps, but I will show you my checklist for the technical. Now, this is just sort of a rough draft right now, and I will change this over time. But I came to the realization a few weeks ago that there are 2 really important rules when it comes to technical or using this strategy. The first, and this comes back, this is fairly similar to Warren Buffett, but I don't think Warren Buffett's rules should be used or should be considered serious, because his first rule is don't lose money. And then the second rule is don't forget rule number 1. But I think a lot of investors out there see those rules that Warren Buffett has suggested lightheartedly and follow those rules to a max. They are serious about those rules. They use margin of safety, probably too much, too high of a margin of safety, that sort of thing. And they find it really hard to buy any sort of quality company. But when I actually did look at some of the rules I was developing for this particular portfolio or this strategy, these are the 2 rules that are the most important. Don't lose money. And don't forget rule number 1, don't lose money. And one of the rules I do have is if a company share price is down 10%, sell. Now, you might say I did not do that with Domino's Pizza, but because my conviction on Domino's Pizza was fairly small, my holding that was really, or fairly low, the conviction. My holding in that company was really, really low. And then I saw the share price drop way more than I thought it was going to drop. And I thought it would be ridiculous selling out of position right now. In fact, I bought more shares because I think there's a good chance it might bounce because of the overreaction from the market. So another rule maybe I should have is being a little bit more flexible with these rules. Don't always completely follow these rules 100%, but overall or generally follow these rules. So if a share price of a company is down 10%, sell, and liquid stocks only. So that is one thing I have learned over the past 6 months is only trade liquid stocks. So I bought Vista Group, and that share price of that company is just so what's the word, violent up and down because it's liquidly traded. And I just wanted to get out, and I had to wait maybe 2 months to sell that position, wait for the bit of the bounce. Anyway, so don't lose money. And the realization that that is the most important rule when it comes to technical strategy, because when it comes to rules, what sort of trades I'm going to make is sort of arbitrary, subjective. And what I mean about that is I'm looking for breakouts, but I just don't want to confine myself to breakouts. So I'm going to look at all sort of possible trades. And you'll see that with one of the companies I'm going to show you, a company called Development Partners or something. That is definitely not a breakout. So I don't want to limit myself to just using one trading strategy. So I don't have a rule when it comes to trading strategies. But the most important rule, the rule I want to follow is don't lose money. Sell when the share price is down 10%, but be a little bit flexible, but not too flexible when it comes to that rule. And at this point in time, this strategy is working really well. And if you look at the holdings I currently have, only 2 companies are down right now, and the majority of companies are up over 10%. One company is up over 100%. And if I compare the performance of companies within this portfolio to the other 2 portfolios, you can see a night and day difference between the 2. And that's why this portfolio is performing really well, because of these rules. And also understanding what is or what could be a good trade. And I try to talk more about that when we look at the charts of these companies that are currently owned in this portfolio. For those living in Brisbane, how humid has it been over the past few days? One of the most humid days we've seen in Brisbane for a long, long time on the Saturday. When I say humid, I don't mean relative humidity. As a professional meteorologist, we never look at relative humidity. It is irrelevant. We look at what's called dew point. And I had all my training in America, United States, And even there, dew point, the public know about dew point. But in Australia, the most frustrating thing as a professional meteorologist is that the public doesn't understand anything about dew point. They just focus on relative humidity, yet relative humidity means absolutely nothing. In fact, relative humidity, if you actually compare relative humidity to temperature, you notice that when temperature goes up, relative humidity goes down. When temperature goes down, relative humidity goes up. So there's a relationship between temperature and relative humidity. There's no relationship between temperature and dew point. Dew point is a measure of the moisture in the atmosphere. That's why we look at dew point. And you'll notice if you do look at the relative humidity on Saturday, the 27th of January, nothing unusual there at all. But when you look at the dew points, really unusual. In fact, overnight in Brisbane, the dew points got as high as 26.8. And I can only think of one time in the past 20 years we have seen dew points get that high. And I wasn't even here, 27.1. Someone did tell me that about that in 2004. So since I've been living in Brisbane, I have never seen dew points as high as 26.8. And the reason we are seeing dew points of 26.8 is because of that TC, Kirrily or whatever it was. It's moved inland into the central part of Queensland. And if you just know how air flows around a tropical cyclone, on the eastern side, the airflow is from the north. And that airflow, that air mass, has been coming down into southeast Queensland. So in southeast Queensland, we are now experiencing a purely tropical air mass. In fact, if you look at the dew points in Brisbane right now, they're fairly similar to the dew points in Darwin. In fact, they might be even higher than Darwin. So it is like living in Darwin right now in Brisbane. That's why it feels so humid in this part of the world. And there's possibilities that that sort of humidity might be going all the way down into Victoria and New South Wales in the next few days. There is that possibility. I haven't looked at all at that. In fact, I don't care because I don't live down there. But that's why it feels so humid. Anyway, this is not a weather channel. This is an investing channel. And in this video today, I'm talking about charts, a technical update. I might go through the indices quickly. Actually, I'll have a look at the daily chart. A nice little bounce, the XGO in the past week. In fact, it went down into a nice little support zone at about 7,360. And the reason I say that's a support zone, it's a shorter term moving average channel. And a lot of times you will see that as a support zone. And we definitely saw that with the XGO. In fact, we also saw that with the XSO. In fact, the XSO has bounced off that support zone twice in the past, say, 2 or 3 weeks. At around about 2,820. We need to see both indices get past the highs we saw back in, when was that? I'm just going to decrease. I can't see the timeframes there. Back at the start of, or the end of December, start of January, we saw the XGO get as high as 7,640, currently 7,555. For me to be more bullish on the XGO, I need to see it get above that really strong resistance level. And the reason that's a really strong resistance level is because every single time in the past almost 3 years, the XGO has got to 7,600. It has struggled and fallen away. And if it breaks above that, you're going to see a bit of exuberance in the market. That's my prediction moving forward. And it wouldn't be surprising to see the XGO go on a bit of a run. Now onto the NASDAQ, which is definitely still bullish. And this is why the NDQ has performed really well this is not an all-time high. Oh, it is an all-time high. I thought maybe it hadn't reached the highs we saw back in 2021. The NASDAQ is at an all-time high. Can you believe that? And in fact, this is a beautiful looking chart, still running hardly. And as I mentioned before, that shorter-term moving average channel, this is at sort of the top shaded area. Last time it moved into, the NASDAQ moved into that area, that was at the start of January, you saw a nice little bounce. So sort of like a buy the dip situation there for the NASDAQ. Russell 2000, which is a small cap proxy indice, that's similar to the XGO XSO, so not quite as bullish. But the Dow Jones, which is the industrial, which is 30 companies, that's actually looking pretty good. Is this an all-time high as well? Let's have a look. Yeah, it's an all-time high. So the Americans are loving life right now. Dow Jones all-time high, NASDAQ all-time high. And this is one of the advantages of investing on the American markets. You can take advantage of when they're fairly bullish. And probably the best thing I've done in the past 3 years is start investing in strong quality American companies. Microsoft. Microsoft. I've missed out a few. Didn't invest in Nvidia, but that's okay. The rest of them are doing fairly well. Now let's have a look at some commodities. Gold. Nothing too exciting with gold at all. I keep hearing that, oh, gold's been performing really well, but when you look at the gold chart, no, it's not yet. And this is, technical analysis works. Resistance and support areas work. And you can see that with the XGO. Every single time it gets to 7,600, it falls away. You can see that with gold. Every single time gold gets above about 2,600, 2,060, not 2,600, it struggles. We have seen this time and time again over the past few years. We've seen it 1, 2, 3, 4, 5 times in the past, actually 4 years almost. Whenever gold gets to 2060, it struggles. And look what's happened. Remember, when was it? Late November. Everyone was so excited about gold because it went through that resistance level on strength, or it seems like on strength. And they're talking about how gold was breaking out for a week after that, even though gold went straight back down. Because people don't look at charts all the time. They just remember what happened 3 or 4 days ago and think it's broken out full time. Not full time. It's confirmed breakout, and this was not a confirmed breakout. It struggled again. It got above 2060 again in late December and fell straight back away. So we need to see gold to get above 2060 before I become bullish on this commodity. Iron ore actually had a little bit of a down period, and now it's starting to go back up again. This is sort of maybe not a dead cat bounce. What's the opposite of dead cat bounce? A buy the dip situation. And the important level for iron ore is around $130. If it falls below $130, that will be a bearish signal, but it's on the rise again, iron ore, which is why some companies, Fortescue, share price is rising. Uranium, it's had a bad week. So it's down below $100. So uranium has fallen 6% in the past week. So this is the worst week uranium has had since September 2022, when it fell 8.7%. At that point in time, uranium was down below around about $50. So it's doubled since then. So just because something has a bad week doesn't mean that's a shift in sentiment, a shift in trend. You need confirmation. And it's been on a massive run in the past 6 to 9 months. So you would expect some weakness eventually when you see something rise exponentially like uranium has done. Oil, now I did sell out of Crude Energy because they did release a bad report. Now the share price did not fall 10%. Maybe that was a mistake because oil has gone on a nice little rally the last few days. Back up to $78 a barrel. And the main reason I bought Crude was because I thought there was a chance that oil could rally from then. And it has, but then I sold out of Crude Energy, so I really can't take advantage of that run in oil. Lithium keeps going down. Let's have a look at the weekly chart for lithium. Keeps going down. I'm waiting for an end. I'm waiting for a week where it's positive at least, but it's still going down. In the past week, it's down 1.5%. Previous week to that, 1.6% down. 1.2% down, 7.2% down, week before that. Every single week, down, down, down. And that's why when you look at lithium companies, they're all so weak right now. But this is the time, in my opinion, to start your research on which lithium companies to buy if we start to see, we get signs that the bottom is, we're getting towards the bottom in the lithium commodity. Copper, always follow copper, Dr. Copper. And one of the reasons I always follow copper is because it is maybe not a true gauge, it is a good gauge on the health of the economies. That's why they call it Dr. Copper. And to be honest with you, when you look at the daily chart for copper, nothing too exciting. I do own one copper company, Hillgrove Resources. That company is going to production this year. Coal, I did buy Whitehaven this week. One of the reasons I bought Whitehaven Coal is because there's a dislocation between what's happening with Whitehaven Coal's share price and the price of Newcastle Coal futures. This is thermal, I believe. Whitehaven Coal might be thermal and metallurgical, but Newcastle Coal is right on a support level. So I'm waiting to see if there's a bounce. If there's a bounce, I wouldn't be surprised to see Whitehaven Coal go on a little bit of a run. Bitcoin, I do own Bitcoin. but I don't follow Bitcoin's chart all that often. It can be quite volatile. And everyone was talking about how weak Bitcoin was about a week ago, and it's gone on a nice little rally since then. So just go against the trend of what everyone's saying, and you might do fairly well in all things investing. So if you see an overwhelming amount of people fairly bearish on something, more than likely that's a sign to get in. Bonds. So bonds are on a bit of a tear. Since the lows in late December, the 30-year American bonds have gone from a yield of 3.95% to 4.37%. So this could be a sign. But if we just put that line a little bit across, it's right on the line, a fairly important line, which was a resistance. Then it became support. Then it became resistance. And now it should be a bit of resistance. So it became support here, then became resistance, and now it's resistance. So if that makes all sense. So let's see what happens with the bond yields moving forward. So this is a sign that the bond market is now less confident there's going to be as many rate drops in the next year. That's the way I read this. They were a little bit too excited back in December. Remember, there was a good run on the equity markets, and the whole reason there was a run on equity markets is everyone thinking there's going to be a 500 rate drops in 2024. And now the bond market's saying, well, I'm not sure about that anymore. Not sure there's going to be many rate drops this year. And if you look at the 10-year Australian bond yields, fairly similar, which they should be. Now, I do have 1, 2, 3, 4, 8 companies charts I want to show you. But before that, these are companies I don't own, but companies I will be following or am following. So let's have a look at my short-term portfolio. And I'll talk about all these companies' charts and whether or what I'm thinking about these companies right now in terms of trading. First one is GUD. This is a company I've owned actually for a while, since August, so almost 6 months. I bought 11.17, share price is 12.10. So a little bit of a profit here, but not a lot. And this is probably the closest I am to selling a company at this point in time. Now, if the share price got above 12.50, why 12.50? So the highs we saw back in September, that would actually be a fairly bullish sign. And the share price has been rising over the past few months. Yeah, so this is the company I'm closest to selling right now is GUD Holdings. And I think one of the reasons why, I wouldn't call it a mistake, I think the market was getting a little bit too excited back in August around their results. And that's why the share price on the 15th of August rose 15%. That was my catalyst for buying in. That looked like a really good report. But the share price has just gone sideways since then. Now, sometimes you will see the share price consolidate after a really good announcement, and then you have to wait for the breakout following that. But usually that breakout happens well before 6 months. So I think the market is forgetting about those results in August, and now we have the results coming soon in February. And there's a possibility maybe the results will disappoint. And that's another reason why I'm thinking about selling out of my GUD holdings and just take profits. So probably less than 10% profit right now, or around about 10% profit, and I'll probably take that. Even though it's only after 6 months, I will take that. Going from GUD Holdings to step one. So this was a classic breakout trade. So share price was struggling to get above 36 cents. It broke out above 36 cents on the 22nd of August. High volume came in. You can see a massive increase in volume, not only when the share price broke out, but days after that. That's a good sign. I bought at 53 cents, so not quite when the share price broke out. I actually did wait a little bit too long for that, but it doesn't matter because the share price has more than doubled since then. Now, you see, if you look at these one-day candlesticks, there's been some days where share price has dropped a lot. For instance, on the 15th of November, share price dropped 14%. On the 29th of November, dropped 6.7%. Recently, we saw the share price drop 7% on the 10th of January, and even more recently, on the, what date's that? That's the Wednesday, 24th of January, it dropped 5.5%. So you're going to see that when the share price or chart looks like this, particularly if shares are illiquidly traded, I wouldn't say step one is illiquidly traded, you will see a little bit of volatility in the share price. But the most important thing is when the share price has gone through these big down days, you do see a nice recovery in the share price soon after. In fact, the last 2 times the share price has dropped, we saw a recovery in the share price the next day. So this is a very important when it comes to step one. Don't panic if you see a big down day. Don't panic at all. Hub24 was simply, again, this is when I bought in August. So some of these companies I've held for 6 months. This has done okay, up $5. So we're talking about 15 to 16% rise in share price in the last 6 months. And this was another breakout. So good results. Share price broke above a nice little, not that strong of a resistance level. And the most important thing here is, so bought on the breakout, or soon after the breakout. Again, I waited a little bit longer. And you can see the share price tests that old resistance level. This happens a lot. I'm surprised how often this happens. When a share price breaks above a resistance level or a support level, breaks down below a support level, you often see the share price test it. And this is what a test looks like. You can see at Hub24 back in October. So 2 months after the breakout, share price went down to $30. And again, a round number. For some reason, investors love round numbers. Tested $30, tested it supported it, it didn't break down below, and then it saw the share price go on a beautiful run. It's gone from $30 to $37.66. So over 20% rise in the share price after the test in the breakout, test of the breakout. And it saw fairly low volume when it tested that, which is a good sign. There weren't a lot of sellers. So have a look at the volume. It's all related. Some might say Hub24 is more of a high quality company than a sort of a trading company. I probably could agree with that. Probably. But I just saw a trade here, so I thought I would trade it. Another company that some might argue is a higher quality company is Darker Data, and this is just simply a trade. This was late August. So quite a few of these companies I bought in August and still holding. So I bought at 10.36 on a good results. Share price took off, and this was definitely see a shift in sentiment, shift in trend in share price on the back of a positive announcement, positive financial results, and that happened in August, late August. Bought at $10.36, so actually a little bit after the breakout, and the share price keeps on rising. You can see little periods of time the share price struggles. So between 8th of December and the 18th of January, share price went from about $12.20 to $11.20. Now the share price is going back up. So nice little dip, sort of buy the dip situation with Dicker Data. Possibly take profits in that company eventually. Maas Group. So we're getting to my more recent purchases. So Maas Group was a breakout above this little resistance level at $3.45. I haven't told about my convictions with any of these. So GUD Holdings, less convicted about this, so more likely to sell. Step one, higher conviction, just because the chart looks beautiful, beautiful trend. And I bought quite a few underwear, and the underwear are absolutely amazing. Hub24, trend, just follow the trend, nice trend. So conviction in this is a little bit higher, but eventually I will take profits in that. Sort of the same with Dicker Data. Trend, the conviction in this one is a little bit higher. So more than likely, I will follow the trend. But you do see probably not as good of a trend as Hub. Hub trend is nice and orderly, it seems like, after the test of the breakout. Dicker Data is a little bit less orderly. You can see the dips a little bit more stronger, particularly the last dip. Maas Group, this one, yeah, I don't know. This one, it's a little bit more orderly, but there's a little bit less liquidity. Sometimes you will see a share price drop and rise a fair bit in one day, just like step one. But this was simply share price broke above this resistance level, went back below it, and then broke above again. That was a good sign. If I just pull this further across, and you can see the share price testing this breakout, which was around 345. You can see I bought it at 345 right on that breakout. A lot of times I won't do that. I'll just wait for confirmation the share price has broken out. So you'll see a lot of times I will buy above the breakout. But this was an instance where I saw an opportunity to buy right on the breakout, sort of a test of the breakout. It tested again in December, and the share, both times, last 2 times it's tested that breakout above that resistance level. We've seen share price go a little bit higher. And now I think we can confirm the share price is now in an uptrend. Next few days, I'd like to see the share price get above $4. The current share price is $3.97. If I see the share price get above $4 and remain above $4, that would be confirming share price is an uptrend. Higher highs, higher lows, that sort of thing. So Maas Group. Bravura is another one where I'm less convicted. I have a little bit less conviction. I bought at 8 cents, share price at 81 cents. So the share price of this company has been a long-term downtrend. And one of the reasons I'm have less conviction about this is because all the shareholders have bought at higher prices in the past. And I think that is still a resistance moving forward. There's still going to be a lot of shareholders who bought at high prices, who still want to set out of this company. And the best thing Bravura could do is release a really good positive financial result. And the reason that would be good is because it gives the opportunities of all those sellers to sell out, because you're bringing extra demand in people who want to now own this company. So what you do is you get sort of a really good turnover in holdings of the shareholders of this company. So you're going from stale shareholders to shareholders who bought more recently. And if they're bought in because of a good financial result, or the share price is now in an uptrend, that is much better than having these shareholders who are on the registry who bought at much higher prices in the past. That's why you want to see a good turnover in shareholding in a company. So you want to see good volume, that sort of thing. At this point in time, the shares of Bravura, I'm going to say Resources, Solutions are slowly grinding higher. Now, this could be a good thing, because if the share price or the share price is grinding higher very slowly, some of those shareholders who bought at high prices in the past just become bored and they just give up and just sell on market. And usually if they just sell on the market, it's sort of like a slow selling. So they do it over a very long period of time, which is why a lot of times I look for a long consolidation period. So this could be a consolidation period for Bravura. And the reason, again, I look for that is because over that consolidation period, a lot of those shareholders, I call them stale shareholders, will sell over that period of time. And what you sometimes see, you can see this, not here, but Zip is a perfect example. So I'm going to go forward in time. So if we go in the past, you can see this massive rally in Zip share price. The share price had fallen a lot over a brief period of time. So share price in a downtrend. And then all of a sudden, we saw some people rush in buying for some reason, sort of wouldn't call it a dead cat bounce. But the reason this little bounce failed is because it happened just after the share price had come down a lot. We didn't have a consolidation period. We had a very short consolidation period. So we still had a lot of stale shareholders in Zip. And that's why this particular rally back in July of 2022 failed, because of all those shareholders who were owning this company, had the opportunity to sell out, and they overwhelmed the demand. And that's why that particular bounce in Zip failed, and why bounce in Zip is succeeding right now. Because a lot of those stale shareholders are probably sold out, and this is a more, well, there's a few reasons why this is a more sustainable bounce in Zip. There's a macro reason, but also more of a micro reason. But I think macro reason is a compelling Zip story right now. But I'm getting ahead of myself. Elders. I had a few people say, oh, I'm not sure about this trade. So they had a really good day on the 13th of November. Share price rallied 18.3%. And some people have said, and I've heard this in podcasts, when you see share price rally like that, well, you've timed it. You're too late. You're too late. You can't. You got to get in before that. And this is an instance where that proved that's absolutely wrong. Just because the share price has rallied 18.3% in one day doesn't mean you're too late. Share price has gone from $7.39 when I bought in after that nice little rally up to $8.82. So the share price is currently about 20% higher. So you saw that 18% rally in one day. Now it's 20% higher. And this is a nice developing chart. Look at that chart. That day was a catalyst for a shift in sentiment and a shift in trend in the share price. And good volume coming in, and that is exactly what I'm looking for. That sort of catalyst to shift sentiment and a trend in the share price. And Elders is the perfect example. I was going to say another thing. And this is exactly what I'm looking for. So, happy with this trade. I bought in soon after this day. And one of the reasons I bought in just after this is because after this 18.3% rally, share price went sideways, which means there was a lot of extra supply on the market. And that's important because a lot of shareholders bought in higher prices. So even though the share price rallied, we didn't see a lot of those stale shareholders put their shares on the market. There might have been extra demand, granted that, but at least demand and supply met each other. And I'll talk about EML Payments soon, and you can see a different story there playing out over the last few trading days. And then, with the share price going sideways, eventually all those shareholders, sales shareholders who bought in the past at higher prices, they've probably sold out by now. So sold out by, say, the 13th of December. They've sold out. So now that supply of shares in the market is falling, and maybe the demand is remaining steady. So more demand than supply, what happens? The share price starts to rally. That's why the share price has rallied on no news, because now the demand of shares in this company is exceeding supply. And now what do you have? In fact, you're seeing increasing demand and not a lot of increasing supply. In fact, supply could be going down. Why is it increasing demand? Trading. Traders like me see the share price moving into an uptrend. They say, ooh, this could be a good trade. So you have increasing demand. You also have maybe increasing demand from institutions who maybe looked at whatever they released on the 30th of November, put those numbers into their models, and 2 months later go, oh, this could be a buy. So you're getting an increase in demand, and supply is not increasing. That's why the share price is going on a really nice rally. So nice. My conviction this is actually quite high right now, but share price up 20% for orders. And one of my goals, not a rule, but one of my goals is to sell when the share price of a company has rallied between 20 and 30%. So this is a possible sell just to take profits, because I don't think this is a long-term hold, but chart is definitely looking way better. And we're now at about an 8-month high. Fenix, so remember, iron ore prices have gone on a nice little rally over the past week. Fortescue share price has got a nice little rally over the past week. Fenix shares have not gone a rally the last few weeks. So for some reason, Fenix Resources share price is not related to the price of iron ore. And I think there's a possibility when this company releases their half-year results in February, the market's going to be a little bit shocked at how good the numbers are going to be, because iron ore prices have remained a little bit elevated, and the cost for this company should have dropped because of some of the things they have done in the past year. Wouldn't be surprised to see again, when this company releases their half-year results, the share price might rally, And that's one of the reasons I bought in at 24 cents. So I'm in profits with this, up about 10%. Actually, it's more than 10%. It's almost 15%. So happy with that. Zip, I've already briefly discussed Zip when I was talking about, was it Bravura? I forget who, yeah, Bravura. And I think this chart is really strong. There was a comment in one of my videos. Someone said, Zip looks atrocious or looks really bad. I thought they were talking about the chart, but maybe they were talking about the business. I don't care about the business. When I'm trading a company, in this sort of instance, I don't care about the business, whether it's bad or good, high quality, bad quality. I'm just trading the chart, trading off good financial news from the company. And even a bad company, a bad quality company, can release good financial news. And Zip has released some good financial news recently. That's why the share price rallied in the past week ago or so. And this chart is looking beautiful. So I bought it at 55 cents, currently 74, so up nicely with this. When I bought at 55 cents, this was a low conviction buy. And my conviction on this is still fairly low because of the volatility. But if I was just looking at this chart without any other information, I would be fairly bullish about this. So, another reason to be really bullish about Zip is the volume increase. Massive increase in volume over the past few months. That's a good sign moving forward. You want to see volume increasing. You want to see institutions getting excited about a company because retail investors alone can't significantly increase the volume. They can slightly, but not significantly. You want to see institutions getting excited about a company. So I think, and the other thing is, share price now for Zip is at 1-year high. So Zip, the company itself, low conviction, low quality company. I don't think they're profitable yet, but the chart is looking brilliant. Again, I mentioned the story and the reason why I think this is a compelling trading position is the macro. If interest rates do drop, a company like Zip will benefit from that. And that's why, or one of the reasons why Zip share price is rallying, because of a change in the macro environment. But there's also a change in the micro environment with the company itself. And just by looking at the chart, The share price rally since it started going up in November, so we're talking about 2 months ago, it's a 2-month rally. The rally we saw back in July 2022 was over a very short period of time. You just see a rapid increase in share price over a very short period of time. When you see that sort of movement, over a rapid movement over a short period of time, it's less likely going to be successful and you're going to see the share price fall away. You want a more orderly move in the share price. And this is exactly what we're seeing here. We're actually seeing higher highs, higher lows. You didn't see a high high here or higher low. It was just zoom up and then straight back down. So EML Payments. So remember, Elder's share price, after that 18% rally in the share price, the shares went sideways. And when you see the share price consolidate go sideways, you got demand equals supply. Everything's demand supply. In fact, if you do an economics course, it should all be about demand supply. So I did take a trading position in EML Payments at 80 cents after that really big down day. Share price dropped, what was it, 20, 30%? We saw a rally the next day, but the share price was weak after that. Share price fell all the way down to 75 cents. And then the company announced they were selling out of that island, PCSIL, whatever it was. Share price, or the market loved that. Share price rallied 22% on the 18th of January, another 10% on the 19th of January. But what's happened after that? So the share price has fallen from about $1 to $1.04 down to 88.5 cents. Why? And the share price has dropped 4 consecutive days. Why has the share price dropped 4 consecutive days? Well, of course, supply of shares in the market is overwhelming demand. So there are more people wanting to get out of EML Payments. So why is that happening? More than likely, it's because all the shareholders who bought between September and December, when the share price was between $1.04 and $1.28, they saw the share price drop to 30% on the 29th of November, and they were feeling pain. They had pain, feeling a lot of pain, emotional turmoil. Now, I'm going to actually admit something here. I have detached my emotions away from my investing. I think that's really hard to do. So last week we had Nanosonics and Dominos Pizza share price drop 30% in one day. That had zero effect on me overall. I'm not sure how I did it, but it has been done. And when I see the share price of a company drop 30% in one day, it doesn't affect me on an emotional level. Likewise, when I see the share price of a company rally significantly, like Step 1 share price rally over 100% since I bought in, it doesn't make me excited. It doesn't make me go, oh, wow, this is great. And I think that could be a really good thing moving forward. But you also have to understand, I have to understand, just because I'm like that doesn't mean the rest of the market, other investors are not like that. Emotional pain, emotions can play a big part on how investors trade. And we're seeing that with EML Payments. So all these people who bought at higher share prices in the past, not only then, look at the chart of EML Payments. So some people are down 90%. And they were getting excited. So just look at the chart of EML Payments before that bad day on the 30th of November. It was starting to look really good. Share price going sideways, that was actually another good sign. But then we had that bad day and then everyone was more negative about this company. Share price was falling, had that good announcement. But the reason why the share price was struggling over the last 4 trading days was because of demand was overwhelming supply, because of all these shareholders who were feeling the emotional pain of being down with EML Payments. They saw the opportunity to sell out and they've been selling. So when I see the share price do this, that's a bad sign. That's actually a negative sign. Now, there is a possibility the share price might bounce from here. The other thing I look at is volume. And we have seen not as high volume as we did see the previous 2 days before that, but the volume has been a little bit heightened. So that is adding weight to we have seen extra supply of shares on market, and the demand, even though it's higher, has not been able to meet that supply. That's why the share price of EML Payments. So there's a possibility I might just take my 10% profit with EML Payments. Yeah, 10% profit. That's all I need. Cobram. So this is one of only 2 shares that I'm down right now. The other one is Dominos Pizza, and mine is slightly down. So I bought it $1.68. Share price of this company is $1.63. So I'm willing to remain patient in this one. And this was a breakout, and I waited maybe a little bit too long to buy shares in this. I should have bought it at about $1.50. This was a beautiful break. Look at that breakout. Shift in sentiment in this company, obvious shift in sentiment, and an obvious shift in the share price. And then we saw a little bit of dip, bit of panic selling. Well, I wouldn't say panic selling. On this particular day, the 15th of January, I actually did follow Cobram Estate Oliver's share price and the trading on this day. And someone did panic on open. I took note to that. So the share price on this particular day opened at $1.54. The previous day, it closed at $1.61. So someone sold on open. Share price went from $1.61 to $1.54. And then we saw buying coming in. We saw actually some good volume coming in that day in the next few days. The share price rallied from $1.54 back up to $1.72. So whoever sold out at $1.54 was just panicking. Again, they let the emotions get the better of them. And this was sort of the buy the dip situation. Now, I would have liked to see the share price rally a little bit more because share price has not really done anything after that. So I need to see a bit of a rally in the share price from here to get above about $1 and we'll say $1.80. We need to see another high. And the other thing to take into account, don't dismiss one-day candlesticks like the 18th of December. On that particular day, the share price of Cobram Estates went as high as $1.92. In fact, $1.93. And then we saw selling coming in. The share price closed at $1.72. So the reason why the share price went to $1.93 and then closed at $1.72 was extra supply of shares on the market, not enough demand to meet those supply. And that was just profit taking. Could be some traders. Was at a resistance level. So go back in time and the share price of Cobram was higher. It's $1.93 back just after it listed. So ultimately, you want the share price to get above $2.20. That would be an all-time high for Cobram, which means there's no resistance on left, because if the share price of a company is an all-time high, there's no resistance. By definition, there is no resistance. Everyone is in the green. Everyone's loving life. Well, not everyone. Every shareholder is loving life. And eventually you will see a little bit of profit taking, that sort of thing. But a profit taking can be more slow over time. But resistance levels tend to be fairly set. And that's why you will see some selling when a company's share price or shares get to resistance level, because there's going to be extra supply all of a sudden on the market. And I think we saw a little bit of extra supply on the market when it comes to Cobram Estates when it got to about $1.90. That's why the share price fell on that particular day. And the share price struggled over the next few days. In fact, the next few weeks. Went all the way back down to $1.54. I think the market is expecting some good results from this company in February. That's what I'm expecting. And if that is true, I think this could be, or that could be the catalyst for re-rating in Cobram Estate Olive's share price. I could be wrong, but it could be true. The only non-ASX company I am trading right now is Snowflake. The reason I'm trading this and have not put this into my Wally portfolio is because Snowflake is not profitable. That is very important when it comes to quality companies. This company is not profitable. But it broke above this resistance level. I bought at $194.88. Current share price is $202, so it's up a few percent. Fair bit of volatility in that. Share price is now in an uptrend. You can see share price moved into the short-term moving average channel here and has bounced higher after that. So a lot of my moving average channels do tend to be, on occasion, some good resistance support levels or zones. Not always. It's an individual, case by case, individual case by case, whatever you want to call it. So you have to look at each company on an individual case by case scenario, whatever. Anyway, so Snowflake. Probably the other reason I bought in was the name. I love snowflakes. Snowflakes. I've lived in snowy places before, and I just love snow. Okay, and MoneyMe. So if you look at the long-term chart here, you don't see much. Because the share price has fallen significantly over the past few years. Share price has fallen from $2.40 to a current share price of about 9 cents. Yes, MoneyMe is a lender to SMEs, I think. But we are starting to see a bit of a shift in sentiment around this company. And look at this. Look at this rally in the share price back here. This is a perfect example of don't be fooled by one-day rally in the share price of a company. Share price of this company rallied 64% in one day on the 31st of January 2023, so 1 year ago. And then look what happened a few days after. Share price just plunged. And that share price plunge just telling me straight away a lot of supply of shares on the market. Why was there a lot of supply of shares in the market? Because look at all the people who bought at higher prices in the past. And even though that could have been a good announcement from the company, it doesn't matter at all. But we get to what's happening now. Okay, so I bought it at 8 cents. I expected this little resistance level to be broken. I expected that, so I was preempting it, and it just worked out fine. In fact, what I'm going to do now is get rid of the longer-term moving average channel. There we are. You can see it much better here. Get rid of that 8 cents. I bought it 8 cents. And this is a beautiful breakout. So it broke out on the 5th of January. Share price on that day rallied 8%. Share price went all the way up to 10.5 cents. You can see it's really struggling between about 10 and 10.5 cents, which is natural. 10 cents is a really natural resistance or support level, because when a share price of a company gets to 10 cents, instead of going up and down by 0.1 cents, it's going up and down by 0.5 cents. So I've seen time and time again over the last 10 years that 10 cents is going to be a resistance level for company share price that is going up, or a support level for share prices of a company going down. And we saw that with MoneyMe. What say is it? We saw that with MoneyMe. Share price gets to 10 cents, it struggles for about 1, 2, 3, 4, 5, 6 or 7 trading days. It struggles. And then we saw a bit of selling coming in. Share price went back down to 8 cents, or just above 8 cents. The resistance level, or resistance price, was 8.4 cents. Share price at one point got down to 8 cents when I bought in. But what happened? When the share price on that particular day, 18th of January, fell below 8.4 cents, we saw buying coming in. We see that one-day candlestick. Let's zoom in a little bit. If you see that one-day candlestick, you see a tail or a shadow below the main body, which means there was buying coming in. In fact, I might look at the 1 hour chart. Might be able to see it better than the 1 hour. Yeah, you can see it really good. So in 1 hour on open, the 18th of January, share price of MoneyMe fell 7.8%. It fell below that 8.4 cent level, support level, and then the next hour, and some good volume coming as well. And then the next hour, share price fell a little bit further. In fact, let's go to 5-minute chart. You can see what happened. Yep, this explains it perfectly. So a little bit of selling, not as much volume, and the share price at 11.10 fell below 8.4 cents. And almost immediately we saw some buying coming in. In fact, the most volume we saw was at 12:15 a.m. when in 1 hour, one 5-minute period, the share price rose 10.84% on high volume. And the reason why was because 8.4 cents was a support level, and this was confirmation. Now, share price now at 9 cents. Go back to the daily chart. So we have tested, the market has tested the old resistance level. Now it's support because it's been tested. Now, what I want to see with MoneyMe is a continual rally in the share price. I want to see share price first get to 10 cents and then break above 10 cents and remain above 10 cents. It can test 10 cents, but I want to see the share price of MoneyMe rally past here, past 10 cents. Am I confident it can do that? Probably more confident now after this test of 8.4 cents. So we'll add to my trading position. Yeah, haven't been thinking about that, but possible add to my trading position with MoneyMe. Okay, Dominos Pizza, massive down day. So I was thinking there might be a breakout here, but I was cognizant of that breakout, that we saw the same thing last year. You can see share price trying to rally. I'll put back in my longer term moving averages. Whoops. Share price was trying to rally, but the longer term moving average channel was still in a downtrend, trying to rally. Recently, we saw the share price Domino's Pizza go sideways, consolidating. So the market was unsure right then. Then we saw the share price get above the top of that trading range. I thought, I'll take a small position just in case this is the breakout. We saw a test of the breakout on the 5th and 6th of January. It looked like it succeeded, but the share price could not get above 59 cents, the previous high, which was a slight concern. So I did take a trading position in Domino's Pizza on this breakout. It was a small position. So thankfully, I was not affected by this, hugely affected by this big down day. And I do think the market is overreacting. Now, in saying that, this one-day counterstick is really weak. When you see this large red body in one day, that's not a good sign. That's actually a fairly bearish sign. When the low of the day is near, or the close of the day is near the low of the day. So I bought it 39.55 cents. And I do think the market is overreacting. When the share price has dropped 31%, even though there were some positives in the report. It wasn't all negative. There was some positive, particularly when it comes to Australia, New Zealand, Germany. I think even Malaysia was positive. There was some slightly negative tones when it comes to Asia, France, and I think the market could be overreacting. Now, here where it comes to important. What am I going to do if the share price continues to fall? Now, this is where it comes important when it comes to resistance levels. So I'm going to move this 39 and support levels, more importantly. So if we go back to 2019, share price of Domino's Pizza fell to around about $36. And remember, instead of one price, I usually have a zone. So you can say between about $36 and $38, the share price of Domino's Pizza remained above that. And whenever the share price fell below $36, we did see some buying. And then we saw some really big volume coming in 26th of August, that sort of week, and the share price went on a nice rally. Look at that rally. And that was the volume, some really good volume. Not sure, that would have been results week probably. So they released some good results, some high volume coming in, and $36 is a really good support level for Domino's Pizza. So if I see $36 or the share price get to say between $36 and $38, that would be a sign to add to my trading position in this company. Now, if the share price falls below, say, 36 to say $35, that would be a really bearish sign. But I just failed to see why it would do that because I don't think this announcement was that bad. It wasn't 30% down bad. I could be wrong, of course. Okay. Now, I'm going to talk about my two purchases in the week. I made two purchases, Whitehaven Coal and Development Partners or something, and why I bought them. So I bought Whitehaven Coal at $7.85. Right here. It wasn't the dip. So we had a dip 18th of January. So share price of Whitehaven Coal broke out on the 4th of January. And it kept on rallying. And then we saw the share price test $7.75, or this little breakout, on the 18th of January. The share price took off on the next day. And I saw the share price go down the next day. And I decided I'll just buy a low conviction parcel in this company just in case. Now, I'm not that confident about this particular trade, but this is the sort of trade I'm looking for, where it does look like there is a shift in sentiment in this company, possible change in the trend of the share price. And if I see the share price go above $8.40, that would confirm to me that possibly there is a change in trend in Whitehaven Coal. Now, I'm also aware that coal prices are not rallying right now. Well, thermal coal is not rallying. And maybe this is an instance where I should be more aware of a company. So I would assume Whitehaven Coal is more metallurgical than thermal, but I could be mistaken. And I'm also aware that even though the share price looks like it's breaking out, if we see a massive plunge in coal prices, that's going to affect Whitehaven Coal. I am less likely to trade mining companies because of that fact. But a lot of times you will see the share price of a mining company move into an uptrend when the underlying commodity they're mining moves into an uptrend as well. Usually you'll see that. And the next company I bought was Development Partners, Development Global. Okay. My typical trade is waiting for a breakout, preferably on good financial news. But This particular trade I have done in the past. In fact, PeopleIn, I did this recently. So we saw a massive drop in share price, huge drop in share price over a week period. In fact, if we look at the weekly chart, Development Global share price dropped 20% last week. So the week before I did this video. Now, if you look at the recent lows we saw, not recent, but the lows we saw in June, that was at $1.80. So I'll just put a line there. Now, in fact, I'll put it just there. So around about $1.80. Now, a couple of things, really interesting things happened in the past week. So we saw the share price. In fact, you can see this if you look at the 5-minute chart for development. Might be a little bit, no, there's enough volume. So if you look at the 5-minute chart, you can see a share price of this company in a well-defined downtrend at this time period. And then on Tuesday, we saw the share price on open in that first 5-minute period, not 5-minute period, it's about 10 minutes after opening. The share price of Development Global fell to $1.86. So right near those lows we saw in June 2022. And then we saw buying coming in. The other more important thing is around that time, look at the volume. We saw some heightened volume. That's another good sign. So we saw heightened volume. Share price tested those old lows we saw back in June 2022. And we saw the share price rally. Nice rally during the rest of Tuesday. Share price went from $1.86 back up to around about $2. And then the share price went sideways. This is another good sign. We didn't see any more selling coming in. Share price rallied. And I bought at $1.99. Sometime, it was late Wednesday. I wanted to buy, it was late Wednesday. I just wanted to make sure there was no more selling. And then what happened on open on the Thursday? On open, we saw a rally in the share price. And Development Global share price went up 10% on that particular day. This is a classic. This is classic. Just looking at the 5-minute chart, this is exactly what you should be looking at. So some nice buying coming in the Tuesday, and that means more than likely the low has been set. A nice little consolidation period. No more selling. That's a good sign moving forward. And in fact, what you might do is just put a line right there at $2. Why $2? You can see the share price after Tuesday's low at $1.86, it went up to $2 and then fell back. Tested $2 again on Wednesday, on open almost, and failed, went back. Tested $2 again late, or actually in the middle of Wednesday, fell back. Tested again at 1:35 on Wednesday, fell back. And then on open, on high volume, look at the volume. Remember, look at the volume. It broke out above $2. That's exactly what you want to be looking for when you are trading, that sort of breakout. Now, if I was smarter, I probably would have waited for that breakout instead of buying $1.99 the day before. But I was actually confident the share price would rally because of what I was just seeing on the chart. And you can see volume on the rest of Thursday was high. And that's why on this one-day candlestick, or the one-day volume, I actually thought it would have been higher than that. It says the volume on this was 800,000 or 600,000, right? But if you look at the 5-minute chart, I suppose maybe if you all add it up, maybe it was not that. But really good volume coming in on this little rally. And this is this is fairly similar. If you compare this, say, to Step 1's daily chart, this is fairly similar. So you can use your trading skill in smaller time period, like 5-minute charts, that sort of thing. So you can use it in 5-minute charts, 1-hour charts, daily charts, weekly charts, monthly charts. And this is a good example of using the skills you develop in trading at a shorter time period. So what am I going to do with development or develop global? So let's go back to the daily chart. So the problem with develop global is a lot of shareholders bought, again, this comes back to demand and supply. A lot of shareholders bought at higher prices. And I think the support we saw between $1.80, $2 is a lot of value investors seeing maybe some value, and maybe some traders are in there as well. Now, it's going to be very important what happens over the next few days. Do we see continued in the rally? So, in fact, what I might do is just look at the 5-minute chart when it comes to this company. And when I see a bit of weakness in the 5-minute chart, I might sell my position. So at the moment, I am up 10%. And this is a case where I'm just willing to take profits in this company. Yeah, anyway. So that's all I've got for these companies that I'm currently holding in, currently holding in my trading or technical portfolio. Now I'm going to go back to a few other companies that I'm going to show you, companies that I don't own right now that I am intrigued about. The first one is a company called TPC Consolidated. Now, actually, you can't look at the 5-minute chart. Let's have a look at the daily chart. In the daily chart, you can see this company is liquidly traded. Many, many years ago, a few years ago, I traded this company. So I bought this company. I've still got what I've got in here. I bought TPC Consolidated at $1. And I can't remember why I bought. It would have been a few reasons. And then I sold half at $3.80. And I think I sold the other half somewhere here. And this is a case, an argument for maybe just holding it. Look at that. I should have bought right here in May 2023. There was a breakout signal at that point. Now, what we are seeing is share price went on a beautiful run, went from $3 all the way up to $10.50. But we also saw volumes decreasing. Now, you might argue, well, you should see volume decrease as the share price gets higher. But here's the thing. A lot of times, when you see a really healthy uptrend, volumes, even though share price is rising, volumes actually increase. That's actually a really good sign. But in this case, we saw volumes decreasing, in fact. And we have seen the share price go from $10.50 to $7.94. Why is that intriguing? Is because if the share price falls to, say, $7, between, say, $6 and $7, it's moved into the longer-term moving average channel. And that could be a support zone for this company. We look at the weekly chart. You can see just by looking at the weekly chart, there's a lot of volatility in this company. It can be up big one week or down big one week and then up big a few weeks later. So this could be fairly similar to what we saw in September last year when the share price of this company was dropped or did drop 26% in 1 week. A few weeks later, the share price rallied 38.8%. So this could be sort of a volatile stock to be interested in. And this company is profitable, by the way. It's a wholesale energy company. Market cap is 90 million. So when I first bought this company at $1, the market cap was something ridiculous like $10 million or just above $10 million. And it was profitable at that point. So no one in the market knew about this company. First time I heard about this company is just before I bought. I went, whoa, this company is profitable. And there was you can see the volume. Just after I bought, there was some big volume coming in. Anyway, so market cap $90 million, dividend yield 5%, price earnings ratio of 5.7. It is a wholesale energy company, and it can be affected significantly by whole energy prices. That's the one thing to be aware of when it comes to this company. 4DX, which is 4D Medical. I just love the volatility in this company. So you can see massive volatility in this company from April of last year. Look at that. Share price rise, share price pull back, share price rise again, share price pulling back. And I'm thinking with this share price pulling back, this could be an intriguing trade or even medium-term trade because some really big volume coming in. Market doesn't like it. And it's just the deals they are making with some big medical companies and universities in America. But the market cap of this company is $234.5 million. So the market is aware of this company. The market does believe this company has some potential, but how big could the potential be? And I'm thinking the market is just waiting for some financial news or results from this company. But just because we have seen a pretty big dip in the share price from $1.08 to a current share price of 60 cents, this could be intriguing buy the dip situation. If I see the share price get down to about below 50 cents, I would be more intrigued, because that's the lows we saw back in September, October last year. Okay, so I mentioned what I did with development developed global is fairly similar to what I did with PeopleIn. And this was a 1 week trade, a 20% 1 week trade. So I bought PeopleIn at $1 or just below $1. You can see rise in volume. Look at the rise in volume around that low. Volume, always look at volume. It's something I've learned over the last 5 years. Volume is really important when it comes to charts and technical analysis. And I do think some chartists don't look at volume at all. And I think you have to look at volume. Well, they look at weird volume stuff, like on-balance volume. Just look at volume. So $1 was really important for PeopleIn for two reasons. It's a round number. So for all companies, round numbers are important. But if you go all the way back to the lows during the COVID-19 financial panic, $1, very important level for this company. So it's not surprising to see a bounce after share price got around $1 and really big volume coming in. And I sold 5 days later at $1.20, 20%. Share price actually did rally to as high as $1.32 on the 3rd of January, but the share price moved into a natural, well, maybe not natural, but a resistance zone, which is the shorter term moving average channel. We have seen time and time again when the share price of this company gets into that channel, in October, November, share price pulls back. And now we've seen it again. Share price got into that channel and has pulled back. I would not be surprised to see me trade this again if the share price gets to $1. It could be sort of a double bottom, that sort of thing. And that would be easy trade for me because buying at $1, if the share price falls to say 95 cents or even 90 cents, just take your losses. It's a bearish signal. It's broken through that support level, and just too much negative sentiment in this company. Look at the trend, that sort of thing. Take your losses. But if I see the bounce, it could be a sort of a double bottom signal setup. Anyway, so, and I think another reason why $1 might hold is because of value investors. It does look cheap. Market cap would be around about $100 million at that point. Dividend yield is 12.6%, price earnings 6.1%. And I have no doubt there would be value investors who are looking at this going, oh, this could be some good value. And maybe some of those value investors were buying at about $1. So there is a few reasons why $1 might hold. And I'm just waiting to see if it does fall to $1 again. Cogstate. Yeah, this is a simple where the share price is right now compared to the lows we saw back in February of 2023. So 1 year ago, I wouldn't be that enthused otherwise about this company. The share price took a little bit of a plunge 2 weeks ago, fell to $1.20, and around about $1.20 is a good support level for this company. So this could be just sort of similar to some of these other companies where it's reached an important support level and maybe this share price will bounce. Now, if the share price bounces, I don't think you're going to get much out of it. So ideally, I would want a 20% bounce. So a 20% bounce from here would be $1.44. So where's $1.44? It's back up to the longer term moving average channel. So I wouldn't be surprised to see it get back up to there, but I'm not confident it will get back up to $1.44. Because if you look what's happening last year, the highs keep getting lower. So again, I wouldn't be surprised to see it get to $1.44, but because the highs keep going lower, share price is in a downtrend, and I'm thinking maybe the bounce could be less powerful. Maybe the high would only be $1.35. So I'm less confident that this share price will bounce from here. And we're not seeing the volume. The other thing is we're not seeing volume. The big volume day was when you're just around the time the share price, or just before the share price went on its plunge. I want to see the big volume when the share price gets towards or right on the support level. That means there's people interested. Okay, Findi. I should do a standalone video on Findi because this is really intriguing. So I've only owned options once in my life, and that was Findi. And the exercise price was 90 cents. Yeah, 90 cents. The options expired on the 17th of January. Now, my options were in net wealth, so they were in my super account. And I had no idea how to exercise my options. So I actually called net wealth and said, what do I do here? I want to exercise my options. I called them on the 15th of January. if I remember correctly. And they said, you have to fill in a form and then you have to send it back to us. Luckily, the next day I did actually work. So I printed the form out at work, signed a form, and then I saw something on the form that really intrigued me. It says, you have to sign this form before, I think it was the 10th of January. And I was like, oh, crap, why? Anyway, I sent my form in, and that was irrelevant because Net Wealth decided to exercise my options. So my options, I bought, it was about 2,000 shares at 90 cents. And I am so glad I did that because look at the rally in the share price. Now, you're seeing a massive rally in the share price on the 15th of November. Share price on that day increased 54.7%. So have a look at the announcement why the share price rallied. It's an obvious rally. And the share price got up to $1.28 and the share price fell. So why is there a lot of weakness? Why did the share price drop between the 16th of November and the middle of January? Why indeed? Why would you think? So there would be a lot of shareholders who held options in this company. So what was happening during that period when the share price was dropping? A lot of shareholders were exercising options to buy at 90 cents. And what they were doing is they were selling their shares in the company at a higher price. So you can see, say at the start of December, the share price was $1.04. So an automatic 14 cents profit. 14-cent profit. Oh, you're going to take that every day of the week. There was one day, and I remember this day, because I was following Findi share price at this point. There was one day on the 9th of January, 1 week before you had to exercise your options, when the share price fell below the exercise price of 90 cents. It was for only a brief period. I'm no doubt this was just some people panicking. Yeah, maybe. I don't know. And then what's happened after the 17th of January is even more, maybe not more intriguing. I'm a little bit surprised. So what's happened after the 17th of January? So all these options have been exercised, right? Less pressure on the share price. But I thought what would happen is people would exercise their options and then sell a few days after. Maybe that's what's happened. But what's happened is the share price has gone on a massive run. Share price has gone from $1 to $1.32. So up 32% in 5 trading days. And I'm thinking, if you go back to demand-supply dynamics, so less supply of shares on the market because all those who exercise their options and wanted to set out probably have. So I haven't sold my options, so my new shares, even though share price is going to rally, I have no reason to sell my shares in this company because I think this company is undervalued right now. And that's another reason why maybe the share price is going to run because the market is aware this company is undervalued. I did actually see an article the other day. What was it, Rask Media, who actually wrote about this and say, oh, this could be a company to have in your portfolio because it does look undervalued. And the other thing to keep in mind is look at the volume coming in. Some really good volume coming in the last few trading days. And the share price, you could argue right now, the share price is breaking out. Now, I'd like confirmation. I would like to see the share price remain above $1.30 to confirm the share price is breaking out. So really intriguing happenings with Findi Limited. Bondi Limited, Findi Limited. For those who don't know, this company owns, well, virtually they own ATMs in India. And India is a cash society. It's not like Australia where, for example, I have not used my ATM card. I have not gone to an ATM. Well, actually, that's right. I went to an ATM the other week to deposit some checks. And then I went into the branch. They had no, what do you call them, where there's a person waiting for you? Whatever that's called. They had none of those. It was just a building and there was just employees walking around going, oh, do you need any help? And I went, yes. And they went to their own little terminal. Did their own thing. There was no checkout people. Not checkout. What do they call them in a bank? The people who help customers. There was none of those anyway. And so India is not like Australia. Maybe eventually it will, but it's a much more cash-driven society. So having ATMs in India is actually a good business model, and it might work for them. This is a really interesting one. Shrine Justice. I wish I was following this. And this happened many months ago. This happened in August. I wish I was following this company at this point in time. This is a classic buy the dip. Not buy the dip. This is a classic support level driven. What do you call it? I don't even know what you call it. This happened on the 18th of August. So there's no reason to be following this company. It's a lawyer company. I think the only reason I started looking at this company was because it does look like the trend in the share price is coming to an end. Sentiment is starting to shift. And I just went, oh, and then I just looked at the chart and went, what happened? What happened on the 18th of August here? So on the 18th of August, the low in the share price on this day was 47 cents. Share price closed at 57 cents. The day before, the share price was like almost 60 cents. So, and then you can see the massive volume. Look at the volume on that day. Huge volume on that day. And why was I wish I was following this company at this point in time, because if you go all the way back, actually, you have to look at the weekly chart for this. So 48 cents was really important because that was the lows we saw in May 2017. Also, the lows we saw back in January 2016, which was a really important low because on that week, the share price of this company fell almost 75%. I'm pretty sure that was around the time of Slater & Gordon, and Shine Justice was hit hard because of that, or something to do with work in progress, how they were dealing or treating work in progress had to be changed or something like that. So 48 cents was a really important level for this company. And on that day, when the share price fell to 48 cents, massive volume coming in, massive buying coming in. And that's why on that particular one-day candlestick, this happened in one day. You had to be quick. One day, share price rallied back up over 10%. In fact, if you bought at 47.5 cents, just say 48 cents, you would have been up 20% by the next day. And in fact, let's have a look at the 1 hour chart. We can go back that far. We can. It's not that far back. Look at that. Look at that. Yeah, here we are. Just zooming in there. So, share price plunged in 1 hour, 14%. Some big volume coming in. In fact, that 1 hour, the share price fell to 48 cents. So obviously, this is what I'm thinking. Someone sold on market. Stupidest thing you can do for a liquidly traded company. I would say that Shine Justice is more illiquidly traded. They just dumped on market. So they saw the share price decreasing. If you look at the 1 hour chart here, the share price was in a short-term downtrend, falling from 62 cents to 82 cents to 58 cents before they dumped on market. They just couldn't take it anymore. Oh, God, the share price is falling. It's gone from 82 cents to 58 cents. I can't take this anymore. I'm just going to dump on market. Dumped on market, sent the share price down to 47 cents. And there would have been some people who saw that and went, oh, 48 cents. I'm going to buy. And that's why you saw massive volume coming in just after that. And the share price went on a run. And of course, whoever sold out or dumped on market, probably averaged around 50 cents, sees the share price now at 75 cents and went, share price is now 50% higher. What did I do? This is what happens when you panic. When you panic. Yeah. Which is my opinion. Someone panicked on that day. I have no doubt someone panicked on that day with Shine Justice. Anyway, wish I was paying attention to that company. Otherwise, nothing really to get too excited about Shine Justice right now, but it's just possibly, although I sort of lie, without even looking at the financials, I'm going to say this company might be cheap. Markup 129 million, dividend yield 2%, price to earnings ratio 41.5. But I'd say the reason why price to earnings ratio is 41.5 is because profit is significantly down in financial year 23. So the previous year, in fact, if you look at an average of the previous, say, 4 years, the profit of this company was probably about $20 million. And last year it was 3.3 million, even though revenue is still increasing. So you might say and argue that the revenue of this company, no, not the revenue, the profit of this company can be quite volatile. And I would expect the profit might go back up to, say, $20 million, which means the P/E ratio of this company is 6. So of valuation reasons, maybe this company is attractive. But I'll still be waiting for a little bit of a turnaround in the chart. And yeah, this is a perfect example of what I'm looking for in case of PeopleIn. What's the other company? PeopleIn and Develop Global. This was very short term, and those two companies, PeopleIn and Develop Global, I was following before I did see the share price reach that low. Shine Justice, I was not following in August of last year, not following at all. I just wish I was now. What an opportunity! You could have bought it. I wouldn't have bought it 48 cents. I probably would have bought more than likely around about 55 to 60 cents. That's when I would have bought. So I still would have been up nicely since then. The last two companies I'm going to show you are banks. Not NAB. They're not the four major banks. They're not the two regional banks. They're not Macquarie Bank. These are two South Pacific banks. One primarily has a business in PNG called, is it Kina? Kina Securities. The other one is primarily in Fiji. I'm pretty sure it's Bank of South Pacific. Now, we have seen some interesting trading in both these companies the last two trading days. These companies are not liked by the market because of risk, what do you call it? Sovereign risk. PNG is going through some turmoil right now, that sort of thing. Bank of South Pacific, you can't buy banks that have their businesses in the Fiji and Tonga and all those islands. The risk of taking. Bank of South Pacific has been around for a long, long time. There is not as much risk in these banks as people think. Even Kina has been around for a while. Now, the reason I've included these two companies in this particular video is because of what we have seen the last two trading days. So actually, this is the weekly chart. So Kina has gone up 3% and 3.7% in the last two trading days, which might not seem much, but some good volume coming in. So again, look at volume, some good volume coming in. And this could be a breakout. So I actually was following slightly this company because it looked like the low had been set as low as 71 cents back in April of last year. And possibly we could be seeing a breakout for Kina Securities. The other really important thing about this company is the valuation. So look at some of these numbers for Kina Securities. So I'm just going to, why can't I move this up? Oh, there we go. Okay, so this company has revenue of 166 million, profit of 48 million. You would also think this company has better margins than Australian banks, taking on more of a risk, higher margins. That's naturally so. And I'd say, without even looking and doing any research in these two banks, they have higher margins. So you're getting more for your bank. So in the last year, this company had a profit of $47 million, revenue $166 million. Revenue has been increasing through time, profit has been increasing through time. So exactly what I'm looking for. But let's have a look at the valuation of this company. Market cap, 241 million. So again, profit 40 million. Dividend yield, 12.5%. Price earnings ratio, 4.7. I have heard this company and Bank of South Pacific being mentioned in AusBusiness Core, and most of us saying too much risk, too much sovereign risk. Oh no, too much risk. But you have to look at the risk and look at the valuation. And at this point in time, if you do like a risk reward calculation, I think the risks in this company are not quite there when you compare the rewards you might get if those risks don't pan out. And more than likely, in terms of possibilities, so the worst case scenario, the chances of that happening are fairly low, in my opinion. And maybe the market is seeing that right now. Maybe the market's going, what's happening? These companies look really cheap. Same thing with those lenders like MoneyMe, Resimac, Prosper. I'm going to forget one right now. All the talk over the past few months, just too much risk in those. Too much risk. But again, when a company's share price or whatever is falling and there's this perceived risk, the market is going to overreact to that perceived risk. And you can buy some companies at really low valuations. Sure, there's a bit of a risk, but the rewards you might get if those risks don't play out is substantial. And that's one of the reasons I'm trading MoneyMe and companies like that, because the risk has been overstated, in my opinion, and more than likely the risk in Kina Securities has been overstated, and definitely I think it's been overstated in BSP Financial, which is Bank of South Pacific Financial Group. And just like Kina Securities, we have seen nice little rally in the share price, and the share price right now is a really interesting resistance level. So if we see a breakout in this company, this could be interesting. Let's have a look at the weekly chart. Yeah, actually the daily chart. Probably not a lot of trading in this company just based off the chart. The share price looks like it could be breaking up for Bell, let's say Bell Financial, for BSP Financial. Now let's have a look. And this company's financials just like Kina Securities. Revenue 1.3 billion, income of 443 million. So this company has a consistent profit above $300 million, consistent revenue above $1 billion, market cap of 2.8 billion, dividend yield 12.5%, price earnings ratio of 5.9. If I had to pick one bank to invest in right now, it would be these two, not the big banks. You don't get any value. P ratio of Commonwealth Bank is above 20 now. There's no value in Commonwealth Bank right now. So everyone's just piling into Commonwealth Bank. But in my opinion, the chances you're going to get a better return out of these two banks compared to the big banks on Australia are significantly greater. Sure, there's a bigger risk, but those risks, again, I think are overstated compared to the potential returns you might get out of these two companies. Anyway, if you disagree with me, I'd love to hear your thoughts. If you want just to buy the big banks, you don't want any of these risks associated with these two companies, I'd love to hear your opinion, but I suppose maybe I'm more of a risk taker. I'm more attracted to these two big banks than those big banks. The only way I'm going to buy Commonwealth Bank is if I see a P ratio below 12, P ratio 20. What's the returns you're going to get when Commonwealth Bank, which is not going to grow at all over the next 10 years, if it does grow, it's going to grow minusculely. They've even said, management have even said, the CEO's even said they're not going to grow from here on in. They've even said that. He said, if I remember correctly, he said, look, we're not going to grow, but to compensate for a lack of growth over the next 10 years, we now have less risk. Who cares? I want to see a company grow. I don't care about the risk. I want to see a company grow. That's how you get the returns over the long terms, by growth, or get a nice dividend yield, like 12%. Anyway, that's all I have for this video. If you have any questions, just leave those in the comment section of this video. Otherwise, I'm not a financial advisor, so everything I said about the banks, just completely ignore. So if you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.